Hello everyone. In this video, I'll be talking about inventory simulation. We did what if analysis with simulation, and I did introduce the idea of inventory simulation in class, but this is the video that I'll be posting for the Monday class that I'm missing because of my attendance at a conference, right? So unlike the what if analysis problem that we did in class, this one only has a single point of uncertainty, but the interesting thing to look at here is that the results of what happens with that uncertainty drives the future into multiple directions, which is slightly different from what happened with the what if analysis. What if analysis was almost very static in the sense that the way you calculated the profit formula was exactly the same every single time. But with inventory simulation, depending upon whether you have too much or too little inventory, the costs that you incur are different. So we have to keep a track of whether we have too much inventory or we have too little inventory, and and then calculate costs based upon that, right? So let's look at the problem once more. So like I said, I introduced this in class, but I'll quickly go over the problem once, and then we'll look at the solution, and I'll show you the Excel solution. Now I might split this up into two separate videos depending upon how long this goes, but let's see. Hopefully I'll get everything done in a single one. So Butler Internet Company, which distributes a wireless router, distributes a wireless router. The cost is $75 and they sell it for $125. And so they make $50 per profit. Now, monthly demand for Butler is assumed to be a normal probability distribution with a mean of 100 units and standard deviation of 20. So that is the point of uncertainty. Demand is unknown. We have uncertain demand, and we have to see how we deal with uncertain demand, right? Okay, so proceeding with that. Butler receives monthly deliveries from its supplier and replenishes its inventory to a level of Q. Now, this is this value of Q, the level to which inventory is replenished, is being kept vague for a specific reason, because this is one of those variables that will change to see how our problem overall changes, and we'll get some metrics out of that. All right, so let's talk about this. And at the beginning of each month, so at the beginning of each month, whatever your inventory level was before will be brought back up to Q. So you will always start with Q items in inventory. Now, if monthly demand is less than the replenishment level, you have an inventory holding cost of $15. If monthly demand is greater than the replenishment level, then you have a stock out, and a shortage cost is incurred. So basically, if you have 100 units, if Q is 100, you start with 100. If demand is only 90, for the remaining 10 units, you will be charged $15 per unit, or $150 in holding cost. But if demand, instead of being 90, is 110, 10 units more than what you have, then for those 10 units, for those 10 people for whom you were not able to sell the router, you will charge what is essentially a loss of goodwill cost. So it's a shortage cost. So shortage cost is a loss of goodwill cost, and we'll assume that it is $30. So that's essentially how much you are losing by losing out on that customer. So not just this sale that you're making based off of that, but also potential future sales that you could have made to them, and they are probably not going to come back to you because you don't have the router when they were looking for one, right? So management would like to use a simulation model to determine the average monthly net profit, and they would also like to find the service level. So the two metrics that we are most importantly looking for are net profit and service levels. All right. So let's see what's going on here. Now we are looking at one controllable input, which is Q. So controllable inputs are inputs that we control. So in the previous problem, the what if analysis that we did, there the controllable inputs were what was the sales price and the fixed cost. So these were numbers that we knew right at the beginning, right? So here what we're going to do is we're going to look at different levels of Q. So Q is not going to change once you decide what Q is, but for different values of Q, we'll see how the two metrics that we've calculated, that we are going to calculate, turn out. So what is our service level going to be, and what is the net profit going to be for different levels of Q, right? So Q is the replenishment level. So how much inventory do I start at the beginning of each month? So that's the value of Q, right? Okay. So now there are two situations to consider, right? So as usual, so are we selling more than what we have? Is the demand more than what we have, or is demand less than what we have, right? So if demand is less than what we have, so in case demand is less than the inventory level that we set, so if Q is 100 and demand is 90, so demand is less than the replenishment level, which means that we'll be able to satisfy all customer demand. In this case, essentially service level is 100% because you're able to satisfy all your customers, right? So now the gross profit will be, so you're making $50 per router because it costs $75. You're selling it for $125. So gross profit is $50 per router, but we are also paying a holding cost of $15, right? So I don't think the holding cost was mentioned before. So holding cost is $15. So you're paying $15 on just the excess inventory, right? So you have Q units on hand, you have Q routers on hand, you're selling D routers because D is the demand. Then the difference, Q minus D, is how much holding cost you're going to pay. So the net profit will be 50 times D. So this is the profit from just making and selling the routers itself minus the holding cost. So the net profit will be 50 times D minus 15 times Q minus D. We can calculate this out. I mean, it's really not that difficult. So that'll be, so minus 15 times minus D, that'll make it plus 15D. So it'll be 65D minus 15 times Q. So that's what it'll turn out to be, right? So that's the net profit in case demand is less than Q. Now, what happens if demand is more than Q, right? So if demand is more than Q, we have a shortage cost, and the shortage cost is $30. And so if demand is more than Q, so gross profit is, now, in the previous case, gross profit was 50 times D because D was your demand. But in this case, gross profit will just be 50 times Q because even though demand is more than Q, you only have Q routers on hand. You cannot sell more than what you have. So 50 times Q will be the gross profit. And the shortage cost will be $30 for the number of units we were short by. So $30 times the difference between D and Q. So that will be the shortage cost. Again, you can calculate net profit by subtracting these two. It'll be 50Q minus 30 times D minus Q, and then the minus. So it'll be 80Q minus 30D essentially, right? So that's the net profit in case demand is more than Q. And these are the only two scenarios that can happen. Now, what if demand is exactly equal to Q? Now, either of these scenarios can manage that, because if demand is exactly equal to Q, D and Q are equal. So if in this case, you'll notice that there is no equal to sign here. The equal to sign is here, which means that we are including the D is equal to Q case with the less than case. It doesn't matter. We could have done a strictly less than here and included the greater than, included this as greater than or equal to. In either case, it will work because look at the gross profit. So look at the net profit. It'll be 50 times D minus 15 times Q minus D. But if Q is exactly equal to D, right? So that's the scenario we're looking at. Demand is exactly equal to the number of units on hand. Then Q minus D is 0. So it's just 50 times the demand, right? And that'll be the exact same thing. So Q minus D will be 0, and it's 50 times not demand, but 50 times Q, but we are assuming that D and Q are the same number if D is equal to Q. So we'll get the same value. So you can include it with this scenario or this scenario, and we are including it with this particular scenario. All right. Okay. And then here is an example of the simulation that they did. Now we want to run simulation for 1000 months, and that's exactly what we're going to do. And these are all the things that we need to keep track of each month. So we need to keep track of what our demand is. Then we need to keep track of sales. So demand and sales are two different numbers. If demand is less than the replenishment quantity, then demand and sales are the same number, right? If demand is more than the replenishment quantity, then sales will be equal to the replenishment quantity. So you'll notice that when demand is high, sales are only 100, which means that the replenishment quantity here is 100. So that's the scenario that we're looking at here, right? So if demand is less than 100, you're selling. So you had 100 units, 100 routers at the beginning of the month. Demand was 79. So you sold 79, and that's how much gross profit you made. Holding cost was 315, and net profit was 3,635. Now, in case when demand was 111 units, more than the 100 that we have on hand, sales are only 100 because we only have 100 routers. And we'll make a gross profit of $5,000. And the 11 new routers that we were short by, well, we'll have a shortage cost of $330. and that's our net profit, right? And so we'll do this for 1,000 months and see how things happen. Now, a couple of things that I want you to keep in mind is that we are saying that the holding cost is 315, right? So in this case, demand was 79. So we have 21 routers left over. So what are we doing for those 21 routers? Now, in this problem specifically, ordering cost is not being included, which means that in this case, because we have 21 routers left over, if we have to end up with 100 routers at the end of the month, we have to order only 79 routers, right? We have to order exactly 79 routers. But we are not paying the cost for ordering those 79 routers because that is not part of the problem. All right, so just keep that in mind. No, we are ordering. Obviously, we are ordering the routers. We are including that. I'm sorry, we are including that in the gross profit. We are not explicitly including that as a separate cost. So the gross profit sort of includes all of that calculation because we are ordering 120, selling it for 125, buying it for 75. The difference of 50 is what we are calculating as gross profit. So we are not explicitly calculating that as a different cost. We could do that. Right? Instead of saying gross profit, holding cost, shortage cost, you can say revenue, then you can say purchase cost, then holding cost, then shortage cost. And then you can calculate net profit out of that. It'll end up being the same number. It's not going to be that different. Right? Okay. So let's actually do this. Now, one last thing before you go ahead. So as you notice, so what's been done here is for different levels of replenishment, we calculate the average net profit, standard deviation. We're not going to the standard deviation, but average net profit and the service level. These are the two important numbers that we need. We're calculating. Now, as the replenishment level increases, the service level will obviously go up. By increasing replenishment level, what we are essentially doing is we are increasing the number of units that we have on hand. But you will notice that the profit doesn't always go up. The profit keeps going up. It goes up to one. So the average profit goes from 42 to 44 to 45, then comes back down to 44. And the reason for that is here you're holding too many routers in inventory. Even though you get a service level of 99.4, you're also paying very large, your holding costs are also going to be very large, right? And that's the trade-off here. So if you have too much inventory, you'll be paying very high holding cost. If you have too little inventory, you'll be paying a little bit of, you'll be paying shortage cost. So the question is to find that balance. Now, if you guys have gone through the operations management course, or if you're doing my supply chain analytics course, you know that you can solve this problem using something called the news vendor model. This is basically the news vendor model. So you have cost of understocking, you have cost of overstocking. Using both of those, you can figure out exactly what your replenishment level should be so that you have optimal value. So that's not a difficult thing to solve. But here we are looking at the same problem using simulation. Now, this is a very simple scenario. That's why you can solve this with a simple news vendor model. But if we have 3 or 4 different products with different levels of replenishment, it becomes quite complex quite easily. All right. Anyway, so moving on, let's actually do the simulation. I'm going to open up an Excel sheet, and we'll use this Excel sheet to do the simulation. So we want to do this essentially for 5 different levels of replenishment. We have 100, 110, 120, 130, and 140. So I will try to make the level of replenishment a variable so that we can change that and see if things turn out. But if it becomes too complex for me, then I'll just create 5 different sheets, right? I mean, it's really not that difficult. But let's see how things go. Right. So it's already how long is this video? Oh, I can't tell how long the video is. Oops. Let me put my do not disturb focus. Okay, this is already, hang on. Okay, so this seems like it's almost a 15-minute video already. So I'm going to stop here. I will upload a different video where we go over the simulation in an Excel file. All right. I'll see you all in the other video. All right. Take care.